On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Labor's targeted capital gains tax announcement last week was interesting. We're yet to see all of the detail, but maybe it's got some merit. I was no fan of the proposals we saw way back in 2018 when Jacinda Ardern established a high-powered tax working group chaired by the late Sir Michael Cullen. The CGT framework recommended in that report was much more comprehensive than this recent announcement, and it included most assets, outside of the family home of course. However, it was still riddled with inconsistencies, in my opinion. Small investors were set to be punished at the expense of large fund managers, while equally bizarrely, international shares were actually going to be advantaged over investments in local companies. My biggest concern was that the changes would see asset classes such as shares and businesses hit unfairly hard. I felt that would have been counterproductive given our need to push capital toward those more productive job-creating parts of the economy. Interestingly, the 10 or so members of the tax working group back then didn't all agree. 3 of them, including tax expert and former Deputy Commissioner of Policy at the IRD, Robin Oliver, reached a different judgment. In addition to the official 132-page final report, they released a minority view which outlined their preferred course of action. Both of those reports are available online, and the latter suggested something that looks very similar to this new Labour policy. Oliver and his colleagues Joanne Hodge and Kirk Hope argued that the tax system shouldn't discourage innovation or productivity. They also noted that a more comprehensive CGT could very quickly become incredibly complicated with a raft of exclusions and compliance costs. In the interests of keeping the simplicity of our tax system intact, whilst also maintaining the incentive to innovate, they suggested a CGT on residential rental housing. It was noted that a decent proportion, almost 40%, of the total revenue from the more comprehensive CGT would be from residential houses over a 10-year timeframe too. Labour hasn't released any figures yet for this new one, but back then that equated to $180 million in year 1, rising to $2.4 billion in year 10. Now, I had a lot of sympathy for this minority view several years ago, so I can't help but be intrigued by what the opposition is suggesting today. I think it could prove to be a politically savvy move as well. While being watered down and targeted rather than broad-based, this is a much more straightforward approach than previous iterations of Labour's CGT proposals. That should help avoid another awkward show me the money moment, like we saw during a debate between the then Prime Minister John Key and Labour leader Phil Goff in 2011. It could also garner more public support. A Reid Research poll from earlier this year saw 43% of respondents support a CGT, compared with 36% opposed and 22% unsure. A big chunk of New Zealanders would be unaffected by this new proposal, which targets residential and commercial property specifically. The family home is excluded, as are farms and most businesses outside of those directly involved in the property sector. A few others might get caught in the net, although very few of the small business owners I know own their own land or buildings. The vast majority lease those premises from a commercial landlord, and it's that landlord that would get taxed, rather than that small business. Real estate investors will obviously be opposed to this, although it's unlikely they'd exit the market altogether if it was to eventuate. A CGT won't stop house prices from rising. It might simply slow the pace of gains. However, businesses and shares could be the big winners. Being exempt gives them a strong relative advantage, and you'd expect to see investment capital move away from property and toward these areas. Entrepreneurs and growth companies looking to get bigger and take on the world with new products would benefit, which would hopefully lead to wealth creation and more jobs. We're only about a year away from the election, and this isn't a bad first salvo from the opposition. However, the biggest concern from the voting public might still be how our money is being spent. High earners and asset-rich voters are not opposed to paying taxes, but they do want that capital to be used wisely and effectively. Poor decisions and frivolous spending choices in recent years have dented the credibility of our politicians, especially those in the Labour camp. That trust will need to be rebuilt before voters will fully embrace a CGT, even a targeted one. Thanks for listening, team. We'll talk again soon. Enjoy your week.
For more insights, visit craigsip.com.